If you have a personal active checking account and you are aged 60 or older, the IRS has quietly rolled out 3 brand new rule changes this year. None of these critical updates were mailed to your home address. No formal notification letters were ever sent out. No public announcements or press releases were published online. These strict new enforcement guidelines are hidden inside updated federal compliance targets. Right now, nearly every senior citizen across the country has absolutely no clue that these new rules apply directly to their bank accounts. Today, I am breaking down every single one of these 3 hidden changes. The safe dollar amount seniors have trusted for decades no longer protects you. Normal everyday banking habits you have always used are now labeled high-risk red flags by the government, and simple family money transfers you thought were completely safe are now potentially reclassified as fully taxable income. Make sure you watch until the very end of this video, because the final rule is the most damaging one for retirees, and almost no senior has any understanding of how it works. Hey everyone, my name is Lana Mays. I spend my time researching and organizing clear financial and legal information, specifically tailored for retired and senior American adults. The simple knowledge I share every week can help you protect every asset you have worked your whole life to build and make your retirement finances far easier to manage and maintain. If this valuable information helps you secure your retirement savings, please subscribe to my channel so you never miss these life-changing financial updates for seniors. Let us begin with the first critical rule every retiree must know. For generations, seniors have memorized one specific number to stay safe, and that number is $10,000. The common belief among older adults was straightforward. Keep all your bank transactions under $10,000, and you will never get flagged by federal regulators. This long-held understanding is now incomplete, outdated, and extremely dangerous to follow. Under the official Bank Secrecy Act, any single cash transaction over $10,000 within one single business day still requires your personal bank to file an official currency transaction report, also known as a CTR, directly with FinCEN within 15 calendar days. This official government report includes your full legal name, your official social security number, your accurate date of birth, and the exact precise time of every single large transaction. You will never receive a copy of this filed report for your records. Federal law strictly prohibits all bank employees from telling you this report exists. Here is the massive 2026 change nobody has told you about. The IRS no longer only watches transactions above $10,000. Updated 2026 enforcement guidelines now target consistent transaction patterns below that threshold. Federal algorithms actively monitor senior bank accounts for regular pension deposits, monthly retirement fund distributions, recurring family support transfers, and routine cash withdrawals under $10,000 every single month. The numerical dollar limit is no longer your safety net. The repetitive pattern of your normal banking activity is now the main trigger for federal review and scrutiny. There is a second hidden bank report almost zero seniors know exists, and this powerful report has absolutely zero minimum dollar amount requirement. I am referring to the official Suspicious Activity Report, universally known in banking as a SAR. Your bank can file a SAR against your account for a transaction as small as $200. These filings are triggered by your consistent banking behavior, tracked by advanced bank compliance software, not the total amount of money moving in your account. You will never receive any alert, email, or letter when a SAR is filed on your profile. Strict federal criminal laws enforce total silence from bank staff. Any employee who informs you of a SAR filing faces up to 5 full years in federal prison. You also need to understand another overlooked compliance rule. All money orders and wire transfers exceeding $3,000 require banks to verify and document your government-issued ID under the exact same Bank Secrecy Act regulations. Even if these mid-sized transactions do not create an official filing, they still build permanent government records of all your banking activity. These strict rules apply equally to all credit unions and national banks. Small local community banks receive zero exemptions from federal compliance laws. Do not make the huge mistake of switching banks to a credit union, believing these federal monitoring rules do not apply to smaller institutions. Every single federally insured financial organization in America must follow identical Bank Secrecy Act compliance protocols. This means the best way to protect your retirement funds is not switching banks constantly. It is learning exactly what daily behaviors trigger federal monitoring systems. This essential knowledge leads us straight to the second life-altering rule for seniors. Regular, harmless, everyday banking habits are now automatically marked as federal warning flags by modern algorithmic systems. Let me share the true story of Diane, a 67-year-old retired government clerk from Albuquerque. For 11 straight years, she withdrew $800 in cash every 2 months, purely to cover her weekly household groceries and routine living costs. After her husband passed away unexpectedly, Diane took over every monthly bill he had always managed. She adjusted her budget and raised her bi-monthly withdrawal to $1,000. Just 6 weeks after changing her normal cash routine, her bank's automated compliance system flagged her account instantly and submitted an official suspicious activity report to federal regulators. Diane did absolutely nothing wrong or illegal in any way. She was simply a grieving widow adjusting her monthly household budget. Unfortunately, federal algorithms interpreted her consistent withdrawal pattern as a deliberate attempt to avoid federal reporting requirements. Diane had no idea a SAR was filed on her account for months, until a scheduled bank account review flagged inconsistencies in her profile. A bank compliance officer finally contacted her and asked her to fully explain her changed withdrawal habits. Fortunately for Diane, she saved every single household receipt and bill, proving her increased cash withdrawals matched her new post-widowhood expenses exactly. She successfully resolved the federal inquiry with no penalties or fines, but she admitted she never knew basic regular cash withdrawals could trigger serious federal banking scrutiny before that conversation. This common senior banking behavior has an official legal classification. It is called structuring, defined under Title 31, Code of Federal Regulations, Section 5324. Here is the critical fact most taxpayers completely misunderstand. You do not need illegal intent to get flagged for structuring violations. Regulators only need to see transaction patterns that look structured to avoid the mandatory $10,000 reporting threshold. Consistent regular deposits or withdrawals in uniform sub-$10,000 amounts automatically qualify for structuring review by federal agencies. It does not matter if your money is clean, legal, or fully taxed income, or where your funds originally come from. If you regularly use cash for your daily retirement expenses, your simple fix is consistent financial documentation. Write a short, clear note for every cash transaction you make. Record the exact date, precise dollar amount, and specific purpose for every deposit and withdrawal. If you need to transfer large sums between your own personal bank accounts, always complete one single full transfer. Never split large amounts into multiple smaller back-to-back transactions. Take a moment right now to review your bank statements from the last 90 days. If you find 3 or more separate deposits ranging from $5,000 to $9,500, write every single one of these transactions down immediately. You will need this record for the final protection steps later in this video. Now we move forward to rule number 3, the most misunderstood financial rule affecting millions of seniors nationwide. This rule targets money most retirees never consider taxable income in any scenario. Imagine your daughter sends you $400 via Zelle for weekly grocery shopping. Imagine your son sends you $600 through Venmo to cover urgent car repair costs. Every senior views these payments as loving family gifts and support, not reportable taxable income for the IRS. Under the newly updated 1099-K federal reporting rules, all major third-party payment platforms, including Venmo, PayPal, and Cash App, are legally required to report all cumulative annual payments sent to your account. Once your yearly incoming funds cross the official federal threshold, the 2025 tax year threshold sits at $2,500 per account, with future plans to lower this threshold all the way down to $600 annually. Zelle functions differently from other payment apps, as it processes direct bank-to-bank transfers and avoids the standard 1099-K platform reporting rules. However, the core tax law remains unchanged for all seniors. Any money linked to personal business or self-employment work is fully taxable regardless of your transfer platform. Serious tax problems begin when payment apps report your incoming family transfers, but those same funds are not listed on your filed tax returns. Advanced IRS computer systems instantly detect these income mismatches and generate an official federal notice known as a CP2000 letter. I want to clarify this important detail for every senior watching. A CP2000 notice is not a formal IRS tax audit. It is a proposed tax adjustment that adds accumulating interest fees to your alleged unpaid balance. Let me walk you through Patricia's real and terrifying senior tax story. Patricia is a 71-year-old retired home health aide living in Memphis. She received an unexpected CP2000 notice earlier this year, claiming she owed an additional $1,840 in unpaid back taxes. Patricia did not work a single paid shift during that entire tax year. She had zero earned income to report on her federal tax return. The full truth behind the IRS notice was simple and innocent. Her 3 adult children sent her a combined total of $3,200 via Venmo. These funds paid for her prescription medications and a brand new household refrigerator. Every single dollar was pure family gift support. The payment platform filed its official 1099-K data with the IRS, creating a large unreported income gap on Patricia's tax profile. Once you receive a CP2000 notice, you only have exactly 60 days from the print date to respond formally. If you miss this strict deadline, the proposed tax debt automatically becomes an official government assessment against you. The easiest and most effective fix for all senior families is extremely simple. Ask your children and family members to write personal gift in the memo line for every support transfer. Maintain a basic written log of every family gift payment you receive yearly. Monetary gifts from family members are legally non-taxable income for seniors, but you must have clear written proof to verify this fact for the IRS. There is another critical statute of limitations rule most retirees have never heard of. The IRS typically has 3 years after your tax filing date to challenge or question your reported income amounts. This 3-year window extends indefinitely if unreported income exceeds 25% of your total claimed income. This means mismatched payment app transactions from 2 or 3 years ago can resurface unexpectedly with zero prior warning, even if you never received any old notices at the time. If you have accepted regular family transfers through payment apps for multiple years, with no organized tracking or documentation, take time to download several years of your transaction history. Do not only review your current year financial records. Forgotten old transfers can trigger sudden IRS notices, leaving you completely unprepared with no supporting proof. Before I share your step-by-step protection plan, I need to cover a massive overlooked senior financial benefit. Millions of retired adults qualify for exclusive senior tax exemptions and refunds, yet they never claim the money they are legally entitled to receive. I have compiled every state-specific senior tax exemption into one simple, easy-to-use reference guide. You no longer need to waste hours searching confusing government websites. This complete resource covers every financial benefit available for retired seniors. Countless older adults leave hundreds or thousands of dollars unclaimed every year. This powerful resource is called the Senior Exemption Handbook. You can access it instantly through the pinned first comment below this video. One quick click gives you full access to all senior tax savings tools. Stay focused and watch carefully, because every tip so far builds into your official step-by-step execution plan. I created this entire detailed video specifically to give seniors a foolproof protection strategy for 2026 and beyond. Follow these exact steps in order to fully secure your retirement bank accounts and finances. Step 1. Request your free official Check Systems Consumer Report immediately. Carefully review the full document for unknown account flags, unauthorized account activity, or unexplained bank closures you never authorized. Step 2. Over the next 90 days, document every single recurring deposit you receive. Record the exact source, accurate dollar amount, and full transaction date for all family app transfers. Ask every family member sending you support funds to provide written confirmation stating the money is a non-taxable personal gift. Step 3. Whenever you transfer large funds between your own personal bank accounts, complete the entire transfer in one single transaction. Never split the balance into multiple small transfers. Add a short, clear memo explaining the purpose of your internal fund movement. Step 4. Calculate every payment you received over the past 12 months. From Venmo, Zelle, PayPal, and Cash App platforms. If your total annual incoming payments exceed $2,500, gather all your gift documentation immediately to prevent future IRS income mismatch notices. Step 5. If you ever receive a CP2000 notice in your mailbox, submit a formal written response before the official deadline expires. Remember, the deadline starts on the letter print date, not the day you open your mail. Include all supporting documentation, a concise written explanation, and a signed sworn statement for the IRS review team. If your proposed tax debt exceeds $5,000, consult a licensed professional tax specialist immediately. Step 6. Place a free permanent security freeze on your Check Systems consumer file. If you do not plan to open new bank accounts anytime soon, this freeze does not affect your existing active bank accounts at all. It simply blocks third-party systems from accessing and analyzing your long-term banking patterns, as federal screening technology grows more advanced each tax year. To conclude today's critical senior financial guide, none of these 3 new IRS enforcement rules come with advance public warnings or personal notifications. Your bank is legally forbidden from telling you when a SAR report is filed. Payment apps never alert you when they submit your transfer data to the IRS. This mandatory silence is written directly into federal financial compliance law. Learning these hidden official rules and building consistent documentation habits is the only guaranteed way to protect your legal senior banking activity from unnecessary federal scrutiny, unexpected tax bills, and stressful government inquiries.